You have probably lost more money trying to make something happen than you have ever lost by simply being wrong. That is an uncomfortable truth, because it does not accuse your analysis, it accuses your impatience. It points to the moment after you have studied the chart, formed a view, placed the trade in your mind before placing it in the market, and then felt the urge to act before the market has actually invited you in. The loss does not begin when price moves against you. Very often, it begins when you decide that waiting is the same as weakness. There is a strange cost in trading that almost no one records. It does not appear on the statement as commission, spread, or slippage. It is the cost of unnecessary participation. A trader sees motion and mistakes it for opportunity. He sees a quiet account and mistakes it for failure. He sees another trader posting a gain and forgets that his own job is not to be busy, but to be correct at the right time. The market has no obligation to provide you with a clean trade simply because you are watching it. Some days, the best information on the screen is not a breakout, not a reversal, not a signal, but the absence of quality. Price may be moving, yet not meaningfully. Volume may rise, yet reveal no conviction. A setup may look familiar, yet lack the conditions that made it valuable in the past. To the undisciplined trader, this feels like boredom. To the mature trader, it is evidence. Doing nothing is not hesitation. Hesitation is when you have a valid reason to act and fear stops you. Doing nothing is when you have no sufficient reason to act and discipline protects you. The difference is not emotional, it is structural. One comes from confusion. The other comes from standards. Watch what happens when a trader has no standard for inactivity. He begins lowering the quality of his trades to match the hunger of his mind. He enters before confirmation because he wants a better price. He adds to a poor position because he wants to repair his first mistake. He exits a sound trade too early because the silence between entry and outcome becomes unbearable. Each action appears small. Together, they form a pattern. The trader is no longer responding to the market. He is responding to discomfort. And the market is very skilled at charging discomfort a premium. This is why the art of doing absolutely nothing can become worth more than the next entry technique, the next indicator, or the next clever opinion. Not because inactivity is always right, but because forced activity is so often expensive. The trader who cannot sit still will eventually manufacture risk where none was required. He will trade mediocre conditions with excellent confidence, then wonder why the result feels unfair. So before we speak about entries, exits, size, or timing, we have to examine the quietest decision in trading, the decision not to participate. The decision to let price pass without you. The decision to watch a move unfold and still say, "Not mine." A trader often thinks execution begins when he presses the button. That is too late. By then, the market has already tested his preparation, his standards, and his ability to obey a decision made before price began moving. The first execution of the day is not an entry. It is the decision that certain conditions do not deserve your money. Doing nothing has to be made practical. It cannot remain a noble idea sitting somewhere in your mind. If you do not define what keeps you out, the market will define it for you, and it usually defines it at the worst possible moment. A fast candle will become a reason. A minor pullback will become a reason. A level drawn poorly will become a reason. The trader who has no trade setup eventually turns almost anything into permission. A no trade setup is not the absence of a setup. It is a defined condition where you are forbidden to act. That distinction matters. If your only rule is trade when the setup appears, then every unclear moment becomes negotiable. But if you also know, in advance, when you are not allowed to trade, your discipline becomes executable. You are no longer trying to be strong. You are following an instruction. For example, you may decide that you will not trade when the entry is too far from the level that proves you wrong. This is not a matter of opinion. If the distance to invalidation is too wide, your size becomes distorted, your stop becomes emotional, and your profit target must do too much work. The trade may still win, but it is already badly built. A poorly built trade asks the market to rescue flaws that should have been removed before entry. You may decide that you will not trade when the move has already traveled into the area where your profit should have been taken. This protects you from arriving late with the confidence of someone who was early. When price has already made the clean part of the move, the remaining distance may belong to quicker hands, not to your plan. Entering there may feel like participation, but structurally it is often payment for someone else's patience. You may decide that you will not trade when the signal is present, but the location is poor. A pattern in the middle of nowhere is not the same as a pattern at a meaningful price. The signal may look familiar, but without clean location it has no authority. This is where a trader must be exact. Not every candle formation, breakout, pullback, or rejection deserves the same respect. A trade needs a place, not just a shape. You may also decide that you will not trade when your risk cannot be stated simply. If you cannot say where you are wrong, why that point matters, and what the market must do to confirm your idea, then you are not executing. You are guessing with vocabulary. The danger is not that you lack intelligence. The danger is that intelligence can explain a bad trade well enough to make it feel planned. This is why written restrictions matter. Before the session begins, you should know the conditions that cancel your participation. Too extended, too late, no clear invalidation, poor location, conflicting signal, weak reward compared with risk. These are not suggestions. They are gates. A gate does not debate with the trader once the bell has rung. The purpose of these gates is not to make you timid. It is to prevent your standards from changing while price is moving. A calm trader before the session can see clearly. A trader inside motion is exposed to speed, noise, and the temptation to adjust. When the rules are written in advance, the decision is carried into the market instead of invented inside it. So when you sit in front of the screen, do not ask only, where can I enter? Ask, what would make this untradeable? That question will save you from many trades that look active but are not professional. It teaches you to treat non-participation as a position with its own discipline, its own criteria, and its own value. And once a trader begins to see that every avoided low-quality trade protects something measurable, the next question becomes harder to ignore. What is all this unnecessary activity actually costing him? A trader can be active all day and still be moving farther away from profit. That is one of the hard mathematical truths of speculation. The account does not reward effort. It rewards positive expectancy applied under the right conditions. You may take 10 trades, manage each one with attention, feel completely engaged, and still finish the day having done damage. Not because you were careless in every trade, but because the average quality of your decisions was too low. Every trade carries a cost before the outcome is known. There is the spread. There is commission. There is slippage. There is the small disadvantage of entering after others have already acted. There is the risk of being right in direction but wrong in timing. These costs may look small when viewed one at a time, but repetition gives small numbers power. A few unnecessary trades do not merely add activity. They add friction. This is where the trader must understand the difference between opportunity and exposure. Opportunity is when the odds, the location, the risk, and the potential reward align well enough to justify capital. Exposure is simply having money at risk. The market allows you to create exposure almost any time you wish. That does not mean it has offered you opportunity. When a trader confuses the two, his frequency rises while his edge declines. Think of your best trades as the workhorses of your account. They have the clearest structure, the cleanest risk, and the strongest reason to exist. But when you surround those trades with weaker ones, you dilute them. A strong trade may produce the gain, but 2 or 3 ordinary trades can quietly take it back. The account then appears inconsistent, when in truth the trader has mixed his edge with too many decisions that never deserved equal treatment. This is why doing nothing has mathematical value. It protects the average quality of your trades. If your edge exists only in certain conditions, then trading outside those conditions does not make you more complete. It makes your numbers less honest. A strategy can look profitable in theory and still fail in practice if the trader applies it too often, too loosely, or in conditions where its advantage is not present. The danger is not only the losing trade. A low-quality winning trade can be dangerous too. It pays the trader for breaking selectivity. It teaches the mind that poor process can still produce money. Then the next time a similar condition appears, the trader has false evidence. He remembers the win, not the weakness of the decision. Over time, these lucky outcomes corrupt the sample. A trader who studies only profit and loss will miss this. He will ask, "Did I make money?" when the better question is, "Did this trade belong in my data?" Because your trading record is not just a scorecard. It is the evidence from which you judge your edge. If you fill that record with impulsive, marginal, or poorly classified trades, you poison the very information you need to improve. The practical work is to separate your trades by quality, not just by result. Your best setups should be measured apart from your average ones. Your planned trades should be separated from your discretionary mistakes. Your clean trades should not be grouped with late entries, board entries, revenge entries, or guesses. If everything is counted together, the numbers become fog. And when the numbers are fog, the trader begins changing rules that may not be broken. This is where restraint becomes a form of calculation. Before you enter, ask what this trade will do to your sample. Does it represent the edge you claim to trade? Does it belong beside your best historical examples? Would you want 50 trades just like this in your record? If the answer is no, then the trade may not be harmless. It may be a small leak disguised as a decision. A trading account is not usually destroyed by one bad idea. More often, it is worn down by repeated exposure to trades with no mathematical right to exist. The trader sees movement, but the account feels weight. He sees chances, but the curve shows friction. And once you understand that every unnecessary trade changes the arithmetic, you begin to look at price movement differently. Fast sell-off can look like opportunity because it commands attention. But the market is not generous simply because it is active. Sometimes movement is clean participation. Sometimes it is only the release of pressure, the triggering of stops, or a temporary imbalance that will soon lose its force. This is where the trader must learn to read behavior, not merely direction. Direction tells you where price is going. Behavior tells you whether the move has quality behind it. A market that rises with steady acceptance is different from a market that spikes upward, stalls, and cannot hold its ground. A market that breaks a level and builds above it is different from a market that pierces the level only to fall back inside the old range. The distance traveled may look similar on the chart, but the meaning is not the same. A great deal of movement is created by traders being forced to act. Stops are hit. Late buyers chase. Short sellers cover. Algorithms respond. News creates urgency. Liquidity thins. Price travels quickly because there is little resistance in that moment, not because strong hands have made a lasting decision. If you do not understand this distinction, you may enter after the easiest part of the move has already been spent. Watch what price does after the move, not only during it. Does it hold the new ground, or does it immediately retreat? Does volume confirm interest? Or does activity fade once the first burst is finished? Does the market accept above resistance or below support? Or does it simply test those areas and reject them? These observations matter because real opportunity often leaves traces of commitment. Empty motion leaves traces of exhaustion. A range can be especially deceptive. Inside a range, price may travel from one side to the other with force, but the larger condition has not changed. The move feels important because it is fast, yet structurally it may only be rotation. Buyers are active near the low. Sellers appear near the high. The market is moving, but it is not escaping. In that condition, the trader who expects continuation may be buying near supply or selling near demand without realizing he has stepped into the middle of an old argument. A breakout can deceive in a different way. Price pushes beyond a level, attracts attention, and creates the appearance of a new phase. But if the market cannot remain outside the old boundary, the breakout has not proven acceptance. It has only proven that price was able to travel there. That difference is critical. A level is not truly won because price touched it. It is won when price can do business beyond it and not immediately surrender. The same is true after news. The first move often belongs to speed. It reflects surprise positioning and forced adjustment. But once the first reaction is complete, The market must reveal whether that move has support. If price continues to build in the direction of the news, the behavior has weight. If it snaps back, stalls, or becomes erratic, the first move may have been more emotional than durable. A trader who enters without waiting for that distinction is trading the noise of reaction, not the structure of acceptance. So your task is not to ask, is price moving? That question is too simple. Ask, what kind of movement is this? Is it acceptance, rejection, rotation, exhaustion, liquidation, or discovery? Each has a different meaning. Each requires different treatment. And some require no treatment at all. This is where doing nothing becomes market reading. You are not inactive because you are absent. You are inactive because the behavior has not earned your participation. You are watching whether price is building a case strong enough to matter. You are letting the market prove that the move is more than travel. A trader can have the right idea and still have no trade. This is one of the hardest distinctions to respect, because the mind wants to be paid for seeing something early. You may sense that a market is heavy. You may believe a rally is losing force. You may expect a level to break, a trend to continue, or a reversal to begin. But an idea is not an order. An opinion may guide your attention, but it does not automatically deserve your capital. There is a wide distance between, I think this can happen, and I am willing to risk money here. That distance is where discipline lies. An opinion can be broad. It can be early. It can survive uncertainty. A trade cannot. A trade needs a defined point of failure, a reason for entry, a price that makes sense, and a moment where the evidence has moved from possibility to permission. Without that, the trader is not making a decision. He is giving his opinion a position size. This is why doing nothing is often the correct response to a valid view. You may believe the market is likely to fall, but if price has not confirmed weakness at a tradable location, there is nothing to do yet. You may believe buyers are gaining control, but if the entry is late or the risk is unclear, the belief must remain a belief. The market does not owe you a clean trade simply because your read may eventually prove correct. A market opinion should be treated like a map, not a command. It tells you where to look. It does not tell you when to enter. If you confuse the map with the trigger, you will begin acting before the market has given you enough information. Then your trade becomes vulnerable to ordinary noise because it was built on expectation rather than confirmation. You entered because the story made sense, not because the decision was complete. The danger is subtle. Intelligent traders are especially exposed to it because they can explain their views well. They can connect price action, news, levels, sentiment, and context into a convincing argument. But a convincing argument is not the same as a tradable moment. The market does not pay for explanations. It pays when risk is placed at a point where the evidence justifies it. So you must learn to separate your language. There is the language of opinion. I think. I expect. This could. And there is the language of decision. If price does this, at this location, with this risk, then I act. The first language is useful for preparation. The second is required for execution. When the two become mixed, a trader starts entering from imagination and managing from confusion. The practical test is simple. Before a trade, ask yourself what has actually happened, not what you believe is about to happen. Has price confirmed your idea, or are you anticipating confirmation? Is the risk point natural, or are you inventing one so the trade can exist? Is the entry located where the idea has advantage, or are you forcing participation because the direction seems obvious? These questions slow the hand without dulling the mind. Doing nothing, in this sense, is not rejecting your idea. It is allowing the idea to mature. A trader can watch with a bias and still refuse to trade until evidence arrives. That is not indecision. It is order. The immature trader thinks a strong view demands immediate action. The disciplined trader understands that a strong view only earns attention. The market must still earn the trade. This is where the quiet art becomes very practical. You observe, you form a working view, and then you wait for the market to reduce uncertainty enough to justify risk. If it never does, the opinion remains unused. There is no shame in that. An unused opinion costs nothing. A premature trade can cost money, clarity, and control. A trader who begins the day without structure has already given the market too much authority. The screen will always offer movement. News will always offer explanation. Price will always appear to be on the edge of something. If your day has no frame around it, every tick can become a demand for judgment. You are then not trading from a routine. You are reacting to whatever the market places in front of you first. Professional restraint is not created in the moment of temptation. It is prepared before that moment arrives. The trader who waits until price is moving to decide how he should behave has entered the session unprotected. He may still speak of discipline, but discipline without routine is fragile. It depends on mood, energy, confidence, and the speed of the market. A professional does not leave that much to chance. The first habit is to define the day before the day defines you. Before the session begins, mark the levels that matter, the conditions that would make them active, and the conditions that would make them irrelevant. This is not prediction. It is preparation. You are not saying, "This must happen." You are saying, "If this happens, I know how I will interpret it." That one distinction removes a great deal of random decision-making. The second habit is to decide where your attention belongs. Not every market, time frame, or instrument deserves equal focus. When attention is scattered, standards weaken because everything appears possible. A trader watching too many things often ends up taking the first thing that moves, not the thing that best fits his work. Narrow attention creates cleaner judgment. It helps you recognize when nothing in your chosen field is worth doing. The third habit is to establish trading windows. There are times when your method may have its best opportunity, and there are times when the market may become thin, erratic, or less suited to your approach. If you treat every minute as equal, you invite unnecessary decisions. Time itself becomes a filter. When your window is closed, doing nothing is not a debate. It is part of the operating procedure. The fourth habit is to set daily limits before any result has occurred. A loss limit, a maximum number of trades, a cutoff after a certain level of disorder, or a rule to stop after reaching a planned objective. These are not signs of weakness. They are boundaries around judgment. Without boundaries, the trading day can stretch until discipline is exhausted. With boundaries, the trader protects the quality of the next decision by refusing to let the current session become unlimited. The fifth habit is to review the day while the evidence is still fresh, not to punish yourself, not to celebrate yourself, but to identify whether your behavior matched your preparation. Did you trade inside your planned conditions? Did you respect your windows? Did you act only where your attention was supposed to be? Did you stop when your rules told you to stop? These questions turn experience into usable information. A routine also removes the false need to improvise. The unstructured trader keeps asking, "What should I do now?" The structured trader has already answered many parts of that question. He knows what he is watching. He knows when he is active. He knows what cancels participation. He knows when the session is finished. Because of that, doing nothing becomes easier to hold. It is no longer an empty space. It is built into the day. This is the quiet difference between a trader who hopes to be disciplined and a trader who has arranged his work so discipline has somewhere to stand. The market may still surprise him. Price may still move without him. But his routine keeps him from treating every surprise as an instruction. There are trades that do not fail because the idea was wrong. They fail because the trader could not leave the idea alone. After entry, the work changes. Before the trade, your job is selection. Once the trade is active, your job is preservation of the original logic. That does not mean you become passive or blind. It means every adjustment must answer to the reason the trade was taken. If the reason has not changed, constant interference is usually not management. It is disturbance. A good trade will rarely move in a straight line. It will pause. It will pull back. It will test nearby levels. It will make you watch open profit appear and disappear. None of this is automatically new information. Much of it is simply the normal movement required for a trade to develop. If you treat every fluctuation as a fresh decision, you turn one trade into a series of small negotiations, and each negotiation gives you another chance to weaken the plan. This is where many traders confuse activity with control. They move the stop because price hesitated. They take partial profit because a candle looked uncertain. They add size because the trade moved in their favor and confidence increased. They close early because the position stopped feeling clean. But the market does not become safer because you touch the trade more often. In many cases, the more you handle it, the more fragile it becomes. A position should be managed by conditions, not by sensations. If your stop was placed where the trade idea would be proven wrong, then ordinary movement above that point or below that point is not enough reason to interfere. If your target was based on a meaningful area, then a small pause before that area is not necessarily a warning. If your trailing method requires a structure to form, then moving the stop before that structure exists is not discipline. It is rewriting the plan after the risk has begun. The trader must learn to distinguish information from noise. Information changes the character of the trade. Noise only changes the comfort of holding it. A strong rejection at a key area may matter. A failure to continue after several attempts may matter. A sudden shift in volume, range, or behavior may matter. But a single candle against you, a small retracement, or a temporary stall may only be the market breathing. If you cannot tell the difference, you will keep interrupting trades that needed time, not rescue. There is also a cost to taking profit without cause. A trader may feel wise when he closes a winning trade early, because money has been secured. But if the exit has no connection to the plan, he has trained himself to accept relief instead of execution. Over many trades, this changes the shape of performance. Losses are allowed to reach their planned size, while winners are cut before their planned distance. The trader then complains that his strategy does not pay enough when his own hands have been reducing the payment. Doing nothing inside a trade requires a clear management map. You should know in advance what would justify holding, what would justify reducing, what would justify exiting, and what would justify leaving the trade untouched. Without that map, every movement asks for judgment. With that map, the market must meet a condition before you act. This is not stubbornness. It is obedience to the structure that made the trade valid. The highest form of trade management is not constant adjustment. It is appropriate adjustment. Sometimes that means protecting capital quickly. Sometimes it means accepting that the trade has failed. But sometimes it means sitting through ordinary uncertainty because nothing important has happened yet. The trade is still alive. The risk is still defined. The reason is still intact. So when you are in a position, do not ask only, "What should I do now?" Ask, "Has the market given me a real reason to change the plan?" If it has not, then doing nothing may be the most professional action available. A move can pass without you and still not be a mistake. That is difficult to accept when the chart keeps traveling after you stayed out. The eye sees distance. The mind measures what could have been made. But after the fact, the chart becomes too clean. It removes the hesitation, the speed, the unclear risk, the poor entry location, and the missing confirmation that existed while the decision was alive. Hindsight makes every move look more tradable than it was. This is one of the most common errors in trading, judging a past decision by the final shape of the candle instead of the conditions that were present at the time. You look back and say, "I should have taken it." But should you? According to what rule? At what price? With what stop? With what evidence available before the move was obvious? A missed move is not automatically a missed trade. It only becomes a missed trade if it met your criteria and you failed to act. There is a difference between opportunity and visibility. Some trades are visible only after the danger has passed. They appear simple once price has already chosen direction. But real trading happens before certainty arrives. At that moment, the breakout may have been extended. The pullback may have been shallow. The rejection may not have closed. The level may not have been clean. If those conditions were not good enough in real time, then the later result does not rewrite the quality of the decision. The market will often punish loose thinking with a very specific illusion. It will show you a move you avoided, then make that move look obvious after it has completed. If you accept that illusion, You begin changing your standards to include trades you only understood too late. Then the next time price moves quickly, you enter earlier, with less proof, because you are trying to correct a mistake that may never have been a mistake. This is how a trader trains himself backward. Instead of learning from process, he learns from regret. He sees that price went up, so he assumes buying was correct. He sees that price broke down, so he assumes selling was obvious. But the market's final direction is only one piece of evidence. It does not tell you whether the trade had clean risk, whether the entry was available, whether the setup matched your method, or whether the move offered enough room to justify involvement. You must review missed moves with the same discipline you use for taken trades. Rebuild the moment. What did you know before the move? What had price actually confirmed? Where would your entry have been? Where would the trade have been wrong? Was the reward still available, or had the move already spent its best distance? If you cannot answer those questions clearly, then you did not miss a trade. You observed a move. This distinction protects your standards.